What's up guys, John here. Buying and owning a real estate is an investment strategy that can be both lucrative and satisfying. You can leverage to buy property, enjoy many tax breaks, and the value of the property usually go up long term. Today I'm going to show you 4 ways to invest in real estate. So first way I want to show you is buy a rental property. It is a great opportunity for someone who has the renovation skills and the patience to manage tenant. So the benefit of owning a rental property is such as providing regular income, and property can appreciate over a long period of time. This is one of the big reasons people invest in rental property. They want that regular rental income. It's like having a pension, or it's like having an annuity. The rental check just keep coming in every month, right? Another good benefit is it maximizes the capital through leverage. You know, when you buy a rental property, for example, that is 100,000, all you have to do is come up with 20,000 on hand. That's 20% as a down payment. You'll be able to buy that property because the bank will lend you the other 80%. You will be able to get an 80,000 loan. So it is a great leverage. You control 100,000 asset with a 20,000 cash on hand. There's not that many investment vehicles that let you do that. Think of it, stock market. When you have $10,000 to invest in stock, you can only buy $10,000 of stock. You won't be able to buy 100,000 of stock. So this great leverage, the power of leverage, it's how many people create wealth investing in real estate. So another good benefit is you will enjoy many tax breaks. A lot of expenses are tax deductible when you have a rental property, such as utility, cable, mortgage payments, real estate tax. All these are tax deductible. The biggest deduction is going to be the depreciation of the buildings. This is an accounting measure. It's not something that you pay out. You know, the property always goes up in value. But the IRS, the tax code, encourage people who buy and invest in real estate. They give you something called the depreciation. It's an expense where you can deduct and offset your rental income, which in a way lower your taxable income. So for many real estate investors, like my client, the first 10-15 years, you basically pay no income tax on the rental income because it's almost always offset by the big depreciation. So that's a great benefit. Another benefit is you get full control of the rental property. You can decide when to sell. You can decide what kind of tenant you want for your property, when to raise your rent, when to do a renovations, when to change your roof. All these are within your control. So you are in control of this property. So there's some downside for owning rental property as well. One of it is it can be tedious managing tenants. Remember all the people who will warn you, oh, you don't want to get the call from the tenant for the broken toilet, for the roof leaking. All these are possible. It doesn't come up every day, but it is something you got to deal with. Tenant will have problem, and it is your job as a landlord to deal with these issues. There's also vacancy risk. If you buy a single family home as a rental, you only have one tenant. Once you list the tenant, 100% of your income will be gone. So that's a pretty big, it's called the vacancy risk. If you own an apartment building with 30-40 units, then it's not such a big issue, right? If you lose one tenant, it's only 1 out of the 40. But when you own a single family property, or even duplex, triplex, you have 1 to 3 tenants. When you lose one tenant, it makes a big percentage. So that's definitely something to think of. Another downside is you typically need a substantial capital upfront. For example, if you are buying something in a red hot market such as Los Angeles, New York City, a good rental property will be around $1 million. If you need to make an offer to buy one, 20% of $1 million is 200,000. You gotta have 200,000 on hand in order to invest a good rental property. So that's definitely a downside. The second way to invest in real estate is through real estate syndication or real estate partnership. It is a partnership between several investors. They combine the resources and skills and the capital to purchase and manage property they otherwise cannot afford. We're talking about apartment buildings, for example, apartment building or office building that's worth about $5 to $10 million. If just yourself, a lot of people will not be able to afford that. But if you get together 20 investors, then each person only need to come up with a percentage, and you pool all the capital and resources, then you can buy a big apartment building and hire a property manager to run it. So it is ideal for people who want to own real estate without the hassle of running it. So the benefit of this kind of structure is it's very passive and hands-off. Most of the time you will hire a manager to run this property. You will not get the call from the tenant that your toilet is broken. You will have property manager to deal with this. So it's very passive. It provides income as well. It provides the appreciation of the property. And there's less vacancy risk. Like we mentioned before, if your apartment building has 40 units, if you lost 2 tenants or 10 tenants, it's not such a big deal. You still have 30 units for rent. So the vacancy risk is much lower. Some downside with this kind of investment structure is you have less control over how the property will be run, when the property will be sold. So you have lesser control because you do have other investor and you do have property manager who is running it. So control is an issue. And it's illiquid. Let's say for 2 years down the line, you have an emergency need for the $50,000 that you invested. How do you get your money back? You cannot force everybody to sell this apartment so that you can get your money back, right? So this kind of investment is rather illiquid. There's usually a holding period of 5 to 10 years, depending on how the deal is structured. But typically, you only sell the building after either 7 years or 10 years. So there is a illiquid nature of it. And it's vulnerable to some dishonest managers. You always hear the story like this, right? Some manager, they're just very jealous of you guys making all the money and he's doing all the work. He's going to do some backdoor deal with the tenant. He's going to steal some money from you. He's going to say they hire somebody to repair the boiler but never hire anybody and pocketed the money. So there is a risk like this. And usually you do have to do extensive homework to vet the managers or whoever organize this investment partnership. Their track record is on the line. Their reputation is on the line. So it's up to you as an investor to do the homework, to do the due diligence, to make sure this manager have the track record that they claim and they know what they're doing. The third way of investing in real estate is through real estate investment trust. You hear people say REIT, R-E-I-T. This is short for real estate investment trust. It is a corporation that purchases and operates income property. It is traded on stock exchange just like the regular stocks. This kind of investment is best for investors who want the exposure to real estate, but without a traditional real estate transaction. So think of it, it's just like buying a dividend stocks. So the benefit of this kind of investment structure is very passive. Once you buy the stock, the real estate investment trust, it's passive. You let the company manage and running it, and your job is just to wait for the dividend distributions. And typically the dividend yield is very high. It's in the 5 to 6% range, and it's very liquid. The next day you want money, you could sell the stock and you'll get the money right away, just like the stock. There's some downside though. Since it's public traded, it behaves like a regular stock. It will be subject to the volatility. Right? During every stock market correction or recession, you see real estate investment trust goes down by a lot also. It has that correlation with the stock market. So a lot of people don't like this kind of investment because the reason they want to go into real estate is that it doesn't correlate with your stock portfolio. When you wanted that when the stock goes up, the real estate hold the value. When the stock goes down, the real estate still holds the value. So it becomes a buffer. But if you buy most of your investment is through REITs, you know it's going to go up and down just like the stock market. And there's no leverage. If you have 100,000 to invest in REITs, you can only buy 100,000 worth of REITs. You cannot buy, the bank will not lend you. It will not give you a mortgage to buy more REITs than you can afford. So there's no leverage. And there's no depreciation. You're not going to get depreciation expense to put it on your tax return. So there's no tax write-off. The fourth way to invest is through online real estate platform. You will hear from different blog or YouTube. This platform is like Fundrise or Realty Mogul. These are some of the popular platforms right now. It connects investors who are looking to finance projects with real estate developers. It is best for those who want to join others in investing in a bigger commercial deal. It still requires investing capital, but less than what is required to purchase outright. So if you want to invest in office building, you could invest through this real estate platform and you can put up $10,000, $20,000, or even less. A lot of the online platform let you invest with $1,000, which if yourself, you want to buy the office building, that's $10 million. There's no way you can afford that. So you'll never have exposure or have the opportunity to invest in office building. But with online platform, you can. So the benefit of this platform is you can invest in a single project or a portfolio of projects. You're like shopping mall. You can simultaneously invest in a project that have 10 retail units. You can have geographic diversifications. A lot of these online platforms provide property in Florida, Texas, East Coast, West Coast. Once you invest in a fund, you will have instant diversifications. It is very passive. Once you invest, there's nothing you need to do rather than monitoring from time to time and then collect the dividend that pays out. Some of the drawback, it's illiquid. A lot of them have lockup period. Once you invest, they expect the lockup period to be 5 years. So you can't redeem within the 5 years. Some are more flexible. After a year, you could request to redeem on a quarterly basis. So every platform is different. You just have to check it out. But typically, the money was dedicated and expected to stay there for at least 5 years. So it's illiquid. And there's some different layers of management fees because of the platform is set up. They're doing a service. So they charge a fee, and then the fund charge a fee, then the manager charge a fee. So you got to look at the fine print before you invest to see the fee structure makes sense to you. Okay, I would like to get some feedback from you. Comment below, let me know what you think and what other investment and other way you invest in real estate and you have enjoyed a pretty good return. I would like to hear from you. I also do private financial and tax consultation. For any business inquiry, my email can be found below in the description section. If you enjoyed this video, I encourage you to share it, give me a like button, subscribe to the channel. It's a great support for me, for my channel. I intend to give you all this valuable information, and I produce content like this every week. Please subscribe. I don't want you to miss any. So I'll see you in my next video.